Hi, welcome to this podcast where I'm going to be looking at limited companies and in particular statements of change in equity. It's the first of a series of videos looking at limited companies. So very quickly introducing you to some very basic theory. The big difference between a limited company and any other type of business we've dealt with is something called unlimited or limited liability. Unlimited liability says that the owner is responsible for all the debt of the business. So if I'm a sole trader and I have a business and my business ends up stopping trading and owing, $20,000 to various creditors or people who've lent the business money, I will have to sell my house to make good those debts. Limited liability, on the other hand, is where the owners aren't responsible for any more of the debts than the value of their investment. So, if I was to buy shares in something like, Coca-Cola, and Coca-Cola was to go bankrupt, I would lose my share. So if I bought my share for $1, I lose my $1. What the creditors or the banks who are owed the money by Coca-Cola can't do is to come back to me and say, we would like you now to sell your house because Coca-Cola owes even more money. Two types: private limited company, public limited company. Private limited company shares are not sold on the stock market. Public limited companies are. The shareholders of the business receive something called a dividend. So instead of taking out drawings, which handily also begins with D, every year the company suggests an amount of money per share that they will receive, and the shareholders in theory have a vote on this and normally agree to take that much per share. So if I was owning Coca-Cola shares and the dividend was 5 cents per share and I owned 10 shares, I would get 50 cents, 10 lots of 5. Right, the other thing that we need to know, it's really important because that's what statements of change of equity is all to do with, is reserves. So for a sole trader, we just have the capital account, no problem. For a partnership, we actually have the capital account and we also have the current account. For the limited company, we call where all the money owed to the owners is kept, or we call reserves. And there are two types of reserves. There are capital reserves, there are revenue reserves. And here we're just going to look at three very basic ones, predominantly because they're the three that are used at IGCSE level. There are others, but these are the three key ones at the moment. Key capital reserve is share capital, and that's where the proceeds from the sale by the company of shares goes as part of a double entry. So they would receive cash and debit cash or bank, and they would credit share capital every time a share was sold. So if they sold 10 $1 shares, they would debit the bank by $10 and they would put a credit entry in the share capital. Revenue reserves, they're generated from the day-to-day profits of the business, and they can be used to fund a dividend. So what a business can't do is it can't pay a dividend out of their capital reserve or their share capital. When they sell a share, they can't then just give that money back to the owner as part of their dividend. But they can from the big revenue reserve, which is retained earnings. So a business makes a profit, it belongs to the owner. We credit retained earnings now rather than capital in general for the profit, and then the dividend will get taken out. So it will be debited in the retained earnings account and it will be credited in the bank because the bank is losing an asset. There's another revenue reserve you need to be aware of. It's the general reserve. In a lot of ways, it's less commonly used now, partly because investors understand it more. But historically, that's been where owners or the manager of the business recommends to the owners that they transfer some of the retained earnings from the retained earnings account into the general reserve. So that money or that funding, if you like, is ring fenced, not for paying out to the shareholders as dividend, but for reinvestment in the company in growing that business. So although in theory we could pay a dividend provided we have some funds in the general reserve. In reality, the business is saying we don't want that money to be to leave the business, and we want to keep it to reinvest from future profit. Right, statement change of equity, pretty straightforward, really. Don't let it get overly worried about this. But this is just a way of showing it's far more simple than doing T accounts, but it's a way of showing what the changes are in terms of the reserves and what is owed to the investors by a business at the end of the year. So in a typical question, you may be given the information on what the reserves are at the start of the year, and then a number of things have happened. Okay, the first thing that happens here, I've done this on purpose just to make you think, but we're told there's 300,000, $0.75, could be 0.75 pence, of ordinary shares available in the business, and we haven't been told the actual value of those at the start of the year. Well, that's pretty straightforward. You just need to remember to do 300,000, and because it's given in terms of cents, we've got to remember to do 0.75 times 300,000, and that means that the actual ordinary share capital of this business at the start of the year is 225,000. General reserve, we're told, had 50,000 in it, retained earnings 60,000. So we can get the easy marks in an exam straight away, because on the statement change of equity, we start at the start of the year and we work through all the changes to give the closing balances. So they're not given as a T account. So we can just transfer all that information into our opening balances. Okay, and then what we normally do at the right hand side, we normally do a total column. So there we've done the total column. Okay, the next bit of information we're given is there's 300,000, sorry, there's the business have issued 100,000 0.75 ordinary shares. So I think I've made a bit of an error here, to be honest. I have. So the business has issued $75,000 or £75,000 worth of ordinary shares. I put an extra decimal point in there. Okay, and what we'd then do is we'd make a line in our statement of change of equity, and we would put in there the value of the extra shares that have been issued. Okay, and we'd remember to put that across in the right hand side. Okay, they also paid the final dividend in relation to the previous financial year, and I've deliberately put this above, okay, because that dividend only belongs to the 300,000 shares that were originally issued. So those 300,000 shares that were in issue when the dividend was earned, or the profit was earned, they're going to get 5 cents per share. So 300,000 times 5 cents comes to 15,000, and that 15,000, that's going to be a minus figure. Normally, or very often, the actual account you'll see a bracket written. Here I put the minus figure, but I prefer to put the brackets in myself personally. Okay, and therefore in the total column there's 15,000 gone out. The business then later in the year issue a interim dividend of 0.02, which is either 2 cents or 2 pence per share, and that now will be issued to all the shares on issue. So we've got the 300,000 original shares, we've got 100,000 new shares. We add those two together and we multiply it by the interim dividend. 400,000 times 0.02 comes to 8,000. And that's going to be a minus figure. And what the interim dividend is, it's a amount of money that's paid to the shareholders. And what the business is saying is, we actually think we're doing quite well, and therefore we're going to give you some of the dividend for the profit that you're going to earn during the year early, as a kind of early present. Next thing that happens is the profit for the year. That gets added on to retained earnings in the first instance. So profit for the year is 90,000. We add that on to retained earnings. 90,000 goes in, so it's a positive figure, and in the total column, only 90,000 has gone in. And then the final thing is that the business has recommended to the shareholders the transfer of 20,000 to the general reserve. So what we're going to do is take 20,000 out of retained earnings, and we're going to add it into the general reserve. And this time when we look across the total column, you'll notice that the total column says nothing, because there's 20,000 positive and minus 20,000. We total up all the columns. So we've now got 300,000 of ordinary share capital at the end of the year, 70,000 of general reserve, 107,000 of retained earnings. And then what we do is we do a check sum. The check sum is where we add the money, the total column, and also the final row. And what that gives us is a number of 477,000. And that just is a check that the arithmetic has been done correctly. So I've put a little figure here on the right to show it's correct, because I've done some of the row here, the columns here, and some of the rows over here. So that's what it's used for. And that's all there is to a statement of change of equity. So, example for you to do, very simple, similar to the one that I've done, and good luck with that. And obviously we'll work a bit more on this in the lessons.